Welcome back to the Deep Dive. We are jumping straight into the Q2 2025 earnings call for Cytokinetics, ticker CYTK.
Yeah.
For you, the listener, this deep dive is essential because, well, this company is sitting right at a key junction. They've got this leading drug candidate, aficamten, basically on the threshold of regulatory approval. Big commercial launch coming up.
Exactly right. And this was a really high-stakes call, no doubt about it. But what makes digging in here so necessary is that immediate disconnect we saw.
Yeah, the market reaction.
The financial headlines, I mean, they look fantastic. Huge revenue beat, loss narrowed. But then the stock drops 3.2% the next day.
So investors were clearly looking past those headline numbers.
Totally. Focus entirely on the details around the regulatory path, the timeline.
Okay, so let's unpack this. Our mission today. Figure out the real quality of that massive financial beat.
Yep.
Do a detailed analysis of the aficamten regulatory situation, especially after that PDUFA extension.
Crucial point.
And then identify the critical catalysts, the things coming up for the rest of 2025 that are going to define where this stock goes.
All right, let's start with the numbers themselves, because objectively they looked pretty strong on the surface. The reported GAAP EPS loss was $1.12 per share.
Okay.
And consensus estimates were expecting worse, right? Between $1.35 and $1.42 loss, so a notable beat there.
But the revenue number, that's the one that really jumped out. $66.8 million.
Huge number.
I mean, that just blew past the consensus estimate. What was it, around $2.1 million?
Yeah, about that. It's an enormous gap.
Right. But we immediately have to, ground that number in reality.
Yeah.
Because it tells us exactly why the market reacted skeptically.
Yeah, it wasn't organic sales growth, not even close. It was collaboration money.
Okay.
That massive revenue spike, driven almost entirely by one-time license and milestone recognition, including a big chunk, about $52.4 million from the Bayer collaboration.
So it's like a financial bridge. Vital for cash, keep the lights on.
Exactly. A bridge, not recurring strength. That's why the stock didn't, shoot for the moon.
That said, it's a pretty robust bridge. They ended Q2 with what, about $1.04 billion?
Yep, $1.04 billion in cash equivalents and investments.
Okay, and that's really the most important financial piece for a biotech at this stage, isn't it?
Absolutely. It confirms they are funded well past these key regulatory milestones, past the initial launch phase.
Meaning less immediate risk of dilution for shareholders.
Exactly. Big sigh of relief on that front.
Still, even with that revenue windfall, the net loss for the quarter was still substantial, $134.4 million.
It did narrow compared to last year, but yeah, it's still a big number.
So let's talk about that burn rate, because this is where the money's going, right? Commercial readiness.
That's the story. And if you connect that loss to what they said about the future, management maintained their full year 2025 GAAP operating expense guidance.
Which is high.
Very high, between $670 million and $710 million. And that includes over $110 million in stock-based comp.
So $710 million OPEX. That's aggressive spending, especially before you even have the drug approved.
It is.
I have to push back a bit here. Doesn't keeping that guidance so high introduce a huge risk? I mean, what if the PDUFA decision goes south? Why spend so heavily now?
That's a totally fair challenge. And I think the heavy spend signals two things. First, just really high confidence from management that they will get approval.
Okay, they're betting on themselves.
Big time. And second, it signals the need to hit the ground running immediately at launch. They can't afford a slow start.
Right, got to capture market share quickly against the competition.
Exactly. So they're betting that spending now on infrastructure pays off with a fast ramp up later, even if it means burning more cash today.
And that one-time revenue was absolutely critical to let them do that without hitting the panic button.
Couldn't have done it otherwise, not without raising more money, probably.
And they are definitely working on financial flexibility, too. They mentioned exercising that loan option from Royalty Pharma.
Right. Pulled down $75 million there.
And they still have another option, right, for $100 billion more before late November.
Yep. They're lining up their ducks, preparing for any scenario, securing the runway.
Okay, let's pivot then to the main event. The central equity story, aficamten.
Their treatment for obstructive hypertrophic cardiomyopathy, or oHCM.
So the drug's under review, U.S., Europe, China, all active.
All moving part.
The headline news from the call was that PDUFA extension, the FDA decision date.
Yeah, pushed back. Moved from late September to December 26, 2025. Christmas present, maybe?
Maybe. But management really tried to downplay the significance, didn't they?
They did. They stressed this was consistent with a standard 3-month sort of administrative extension.
Meaning the FDA just needed more time to review extra info they submitted, not like some fundamental safety issue.
That was the message. They said it should have no bearing on ultimate approvability.
Okay, but what gives you listening real comfort here?
It's the supporting detail they gave. FDA good clinical practice inspections, the GCP inspections.
Yeah.
Of the clinical trial sites, they're done, completed, with no observations recorded. 0.
Wait, hang on. A clean inspection is good, obviously, but does it really mean that much? They could still reject the drug based on the actual data, right? Efficacy, safety?
Oh, absolutely. The final data review is paramount. But the clean GCP inspection, that's a huge de-risking event.
How so?
Because GCP confirms the trial was run properly, ethically, data's clean, protocols followed. It basically eliminates a major administrative or process reason for a delay or rejection.
Okay, so it tells us the FDA is now focused purely on the science, the data itself.
Exactly. Takes one big potential roadblock off the table.
So this brings us to the near-term catalysts, the stuff happening soon. That late-cycle FDA meeting scheduled for September 2025.
Yep. This meeting is the critical near-term inflection point. It's huge. Management expects this meeting to basically validate their path towards approval and, crucially, confirm alignment on the REMS program.
Okay, let's break down REMS for listeners who might not live and breathe the regulatory stuff.
Yeah.
What is it, and why does a differentiated REMS profile matter so much commercially?
Right. REMS stands for Risk Evaluation and Mitigation Strategy. It's basically a safety plan the FDA requires for certain drugs.
To make sure benefits outweigh risks.
Exactly. Often involves specific monitoring, like tests or special documentation. For these cardiac myosin inhibitors, the competitor's drug, Camzyos, requires specific echo monitoring before and during treatment.
Which can be a hassle for doctors and patients.
Right. So Cytokinetics is aiming for a differentiated REMS, meaning potentially less burdensome, fewer requirements for monitoring, maybe easier patient enrollment.
Which would make aficamten way easier to prescribe.
Massively easier. Easier to fit into a normal cardiology workflow. That's a huge potential commercial edge.
And they seem confident. They submitted an updated REMS package quickly after talks with the FDA.
Yeah, they highlighted that productive dialogue. Suggests they think they're on the right track for that potentially simpler label.
Okay, so September meeting is key for REMS. What else? Clinical data. MAPLE-HCM.
Yes. Moving from regulatory stuff to the actual science. MAPLE-HCM. Big deal here.
Primary results are being presented soon, right?
Yeah.
Late August. At the European Society of Cardiology Congress.
Yep, as a prestigious hotline session. And this trial, this is where the story could fundamentally shift.
Why this specific trial? What's unique?
Because MAPLE-HCM is the only head-to-head comparison of a cardiac myosin inhibitor, like aficamten versus metoprolol.
Metoprolol, the standard beta blocker, been used for ages.
Decades. It's cheap, it's generic, it's the established first-line standard of care for many oHCM patients.
So unlike competitors who maybe just compared to placebo.
Exactly. Beating placebo is one thing, but a head-to-head win against the cheap, entrenched, generic standard, that's powerful evidence, undeniable.
So if the data really pops,
Yeah.
why does that matter more than just, say, outselling a competitor later?
Because it's about changing fundamental physician behavior. Beating another specialty drug is about differentiating within that class. Beating metoprolol head-to-head. That means potentially disrupting the initial treatment choice. The algorithm cardiologists have followed for years.
Wow.
Management basically suggested this data could get aficamten written into treatment guidelines, make it the preferred first-line therapy for patients who currently just get started on metoprolol.
That's a massive potential shift in the treatment paradigm.
Huge adoption curve potential there.
Okay, sticking with the pipeline, what about non-obstructive HCM, the KCA-HCM trial?
Right, NHCM. That phase 3 trial is fully enrolled now, 516 patients. Top-line results expected first half of 2026.
And they talked about the competition here too, didn't they, in the Q&A?
They did. They kind of referenced obliquely a competitor's previous stumble in the NHCM space.
Implying they learned from that.
Pretty much. They said Cytokinetics was deliberate, optimized their dosing, their study design, trying to avoid the pitfalls seen before. They believe their focus, their rigorous conduct, sets them up better for success in NHCM.
Which is another potentially large market on its own.
Absolutely. Separate opportunity.
Okay, so let's circle back. Regulatory timeline extended to December. That massive $710 million OpEx guidance still in place. How are they using this extra time on the commercial front?
Yeah, they're definitely framing the PDUFA extension as like extra runway to perfect the launch plan.
Okay.
And the key metric they really hammered home was the quality of the U.S. sales force they've hired.
Ah, the team on the ground.
Yep. Highly experienced cardiovascular sales team. Get this. Average 21 years industry experience.
Wow.
And 14 years specifically in cardiology. These are veterans, ready for that expected Q1 2026 U.S. launch.
Is that level of experience absolutely necessary? Because their main competitor, Camzyos, already has a market presence, a head start.
I think that's exactly why. You don't bring in that kind of heavy-hitting experience unless you need people who can immediately challenge an incumbent.
People who already have the relationships know the key centers.
Precisely. They need this team to leverage that differentiated clinical data, especially that MAPLE-HCM data, if it's good, and penetrate those specialty centers fast.
What's the potential market size they're looking at initially?
They estimate about 80%. 80% of eligible oHCM patients are actually treatment naive when it comes to a cardiac myosin inhibitor.
So most potential patients haven't tried either drug yet.
Correct. It means the launch isn't just about stealing patients from the competitor. It's about converting this huge untapped pool of patients onto this newer class of therapy.
Okay, that's the U.S. picture. What about globally?
U.S. is definitely the main focus right now, but yeah, global plans are moving.
Yeah.
Europe, they're targeting an H1 2026 launch starting in Germany.
Makes sense.
And China's also in the mix. Potential NMPA approval there in the second half of this year, 2025. They've got Sanofi as their partner there.
And getting the drug paid for. Access.
Management said they expect access parity with competitors, both commercial plans and Medicare. They're banking on differentiation through the clinical data that hoped for simpler REMS profile and patient support programs.
All right. And quickly, beyond aficamten, the broader pipeline that justifies all this long-term investment. How's that looking?
It's progressing. Omecamtiv mecarbil, that's their drug for severe heart failure with reduced ejection fraction, HFrEF. The COMET-HF trial enrollment's moving along, aiming for completion in 2026.
Any buzz around that one?
Yeah, apparently investigators are really interested. High unmet need in that severe HFrEF population. And the drug's mechanism, cardiac myosin activation, showed a pretty big treatment effect in the sickest patients in the earlier galactic trial.
So potential for significant benefit there.
That's the hope. And then there's Ulahampton phase 2 trial enrolling now for severe heart failure with preserved ejection fraction, HFpEF, another tough area.
Okay, good overview. That brings us neatly to the segment we like to call, This is Not Financial Advice.
The fun part. Disclaimer time.
Absolutely. So we established this stock's trading around, $48.55 as of late September, and the market clearly discounted that big revenue beat, focused solely on the binary PDUFA risk way out in December.
Right. The market's looking at December 26 and seeing a coin flip, basically, pricing in that uncertainty. But we need to acknowledge that risk, absolutely, but then use what we learned from the call to maybe find an angle, right?
Okay.
And the key insight, I think, is that the most influential, the most stock-moving catalysts, they're concentrated right now, late August, September, way ahead of that December PDUFA date.
Ah, so you're saying September is the real hinge point, not December. Lay out the thesis for us.
The thesis is basically this. The market's over-focused on the December fear, and it's ignoring the high probability that these September events could significantly de-risk the whole regulatory path before we even get to December.
Okay, which event specifically?
Two big ones. First, the ESC presentation of the MAPLE-HCM data. If that data is strong, showing clear superiority over metoprolol, that's huge validation. Second, that late cycle FDA meeting in September. If they come out of that confirming alignment, especially on that potentially cleaner, differentiated REMS label, that's massive.
And management sounded pretty confident about that meeting.
Extremely confident, I'd say. Their tone suggested they really expect alignment.
Okay, so how do we potentially play this anticipated short-term clarity? With leverage, obviously, trying to capture that risk premium being priced in now.
All right, so here's the aggressive idea. Again, not financial advice, but maybe a bullish, high-levered options strategy, like a short-dated call spread.
Okay, targeting what specifically?
Targeting a substantial upside move in the stock, driven specifically by positive news out of that September FDA meeting.
And the timing on the options.
You'd want an expiration date shortly after that September meeting, but well before the December PDUFA decision.
Ah, capture the rally, get out before the final binary event.
Exactly. The strategy tries to capture upward momentum triggered by that increased regulatory certainty. If that meeting goes well, especially on REMS, it removes a huge psychological barrier for investors.
Could trigger a near-term rally. Back into the high $50, maybe $60?
Potentially, yeah. Allows you to maybe take profits before that end-of-year holiday PDUFA risk really kicks in.
That is a fascinating strategy. Really leverages the specific timing of these techno catalysts.
Yeah. Oh, great stuff. So just to recap our key takeaways from this deep dive for you listening, we saw that significant revenue beat, yes, but understood it was purely driven by non-recurring collaboration money, not sustainable sales. More importantly, we identified a clear regulatory track for aficamten, but with two critical checkpoints coming up fast in September: the MAPLE-HCM data reveal and that crucial late-cycle FDA meeting.
Make or break September, really.
And we noted that the launch timeline seems absolutely secured by their very robust cash balance, even with that high OpEx spend for commercial readiness.
Cash isn't the immediate worry here. It's execution and regulation. Right. So, final provocative thought for you, the listener.
Okay, here it is. That MAPLE-HCM data, it doesn't just aim for, like, a slightly better drug. It aims to fundamentally disrupt the first-line standard of care for oHCM. It's going head-to-head with generic metoprolol. So the real determinant of this company's valuation, how quickly they become that commercial powerhouse they want to be, it's going to depend entirely on how quickly clinical guidelines actually integrate this new head-to-head evidence, assuming it's positive.
And how fast doctors change habits they've had for decades.
Exactly. How rapidly do physicians abandon that ingrained habit of prescribing metoprolol first? That adoption curve.
Yeah.
That's the metric that truly matters over the next 18 months.
Understanding that adoption curve is everything. Fascinating point to end on. Thank you for joining us on the deep dive. We hope you feel thoroughly informed and ready for those September catalysts. We'll catch you on the next call.